Right, afternoon. I don't know what time it is. My name is Kira Mosley Hobbs, and with me today is Craig Munier. We are with Policy Liaison Implementation in the Office of Federal Student Aid, the U.S. Department of Education. You guys had a really good time so far in your sessions. You should have fun here. Me and Craig are unscripted. And you know that means you don't know what we're going to say. So this is the subject of EFC calculation. And does anyone have any experience with the EFC other than what pops up in Power Fades and Banner automatically for you? Okay, so you know this is a fun subject. And before we do the Q&A at the end, I'll answer all your questions right now. And the answer is, it depends. Good to have you. So what we're going to do today is we're going to give you a little bit of background on the EFC and the purpose. The history of it included Mrs. Molly Orbansky. Formula calculations, the 6 different types, and the simplified needs test and automatic zero EFC. If you did the federal update, you know that the IRS forms eliminate 1048, 1040 easy. And that was really dependent for Auto Zero EFC and Simplified Needs Tests. We're still working through how those form changes affect those 2 formulas, but we're going to speak today as if everything is normal and kosher and everything is the same, because I think the direction we're going in right now is to honor the spirit of Simplified Needs Tests in Auto Zero and try to maintain it even with the elimination of those 2 forms. So if you guys are worried about that, that is going to be the attempt that we make. We get a little bit into a Formula 1. We'll use that as an example as we go step by step through an EFC calculation. We'll do a brief overview of formulas 2 through 6, and then we'll wrap it up and we'll have Q&A, because formally we have to do that, but like I said, all of the answers is what? It depends, exactly. So purpose of the expected family contribution. What is an EFC? So before we get into it, Craig and I will bounce off each other. So Craig is sitting at the table. Wave, Craig. So when Craig wants to jump in and say something, I would allow him to do that. And then during his part of the presentation, when I'm going to jump in and crack a joke, because my side hustle, I do stand-up comedy. Not really. And I'll do that just to make sure you guys are still awake. So what is an EFC calculation? An EFC is a calculated number determined based on information reported on the FAFSA. And along with other data, it's used by the schools to determine students' financial aid package. And as you know, at schools, it's not just federal aid. A lot of schools and organizations use the EFC for also institutional aid and organizational aid. And the EFC is the result of the needs analysis formula as prescribed in Part F of the Higher Education Act of 1965. And I want you to keep in mind that it's the Higher Education Act of 1965. So the EFC formula hasn't really kept up with the changes in our lives as far as what a middle-class family looks like and the different allowances and consideration of income. Did you want to add to that?
Yeah. Good afternoon. So we're going to do this like a duet. Don't sit down. Just we'll sing harmony and stuff. The first thing when I walked in the room, I paid attention to the average age in the crowd, because I knew that would tell me something right there. If you were, most of the crowd was over 55, you were here to, if you were under 55, you're probably here legitimately to learn about EFC. That's what we intended. If you're over 55, you're probably here to see if I know what the heck I'm talking about. Not so good. So anyway, the history of the expected family contribution is one that's always interested me. I don't profess to know it perfectly. I'm going to tell you some of the things. But when I was a puppy in financial aid 100 years ago, you know, I learned from the old timers that were around back then, and they taught me some stuff. And I want to just pass that on for what it's worth, and you take and leave it or whatever you want. But Kira and I were kicking this around one day in the office, and she found it interesting and said, hey, we ought to do this. We ought to include this in the session. One of the stories that I was told, and it's like the movie Fish, you know, I'm sure it's true. I just don't know if it ever really happened, you know, that kind of a thing. But the story that I was told was about a woman named Molly Orshansky. Does anybody in here know who that was? Who she was? That's what I thought. If you do, you're an incredible historian. The story I was told is that back in the early 60s, when the government was they were proposing some kind of a means-tested benefit, and I don't know if it was housing, something with housing or what the means-tested benefit was. It wasn't financial aid. They realized that they didn't have a definition of the poor. Who are the poor? We're going to help the poor, but who are they? And they didn't even have a definition of what constituted the poor. But there was a woman in my wife's department, actually, in the U.S. Department of Agriculture, named Molly Orshansky. And Molly, I was told, had dedicated virtually all of her life in the Department of Agriculture answering one very straightforward question. What's the least amount of money necessary to provide a nutritious, balanced food allowance for an adult American for one day? In other words, what does it cost to eat for one day? And that was the basis, that research and her analysis and her studies became the underpinnings, the basic beginnings of the means-tested benefits of virtually that's still in use in almost every federal means-tested benefit program today, including what we're here to talk about today. So I thought that was kind of interesting. The second thing I'll share, and then I'll turn it back over to my partner here, is there's this thought when I first got into financial aid that this is an exact science. And boy, when we get into the worksheets and stuff, it sure looks like it. It's very formulaic. It looks very scientific. But in my experience, it's more art than science. And we're going to talk a little bit about that. But the expected family contribution in using base year income, which, as you know, up until recently was the calendar year, tax year prior to the FAFSA year, and now prior year, 2 years prior to the FAFSA year, was never intended to determine what a family's ability to pay for college last year was, but rather that by looking at actual experience of income, that's the single best predictor of a family's ability to pay in the future. Some of you may be old enough to remember there was a time when, for independent students, we didn't bother with base year income. We asked independent students what their estimated income was going to be while they were in school next year. It made sense. They were leaving the world of work to go to school, and so what relevance does base year income have to predicting their ability to pay when they're actually in college? But what we found from that experience is that people are terrible estimators. They don't estimate very well. Some people consider anything within $10,000 to be close enough, right? Others want to get it within $1 and some change. So there was too much variance and too much, it just wasn't predictable enough and accurate enough. And so we found that base year income is still the best. Even though it's 2-year-old data now with prior year, it's still a better predictor than asking people to estimate income in the future.
Oh, that was abrupt.
Yeah.
Oh, my.
I should have given you like a 2-minute warning. I think.
Right. That's so funny. Okay. So EFC assumptions are based on the following concepts. And EFC has assumptions because, like Craig was hinting towards, is they had to create a standard method to determine eligibility for people across the country and students across the country. And if you know, standards of living are different from where you are. So like I'm from Baltimore, Maryland, and our standard of living is half of our city is boarded up houses, which is different than, let's say, Manhattan in New York, which is different from where Craig is. Where are you from? Iowa, Nebraska? Somewhere with cornfields and rhubarb.
Someplace you've obviously never been.
I fly over wherever he's from, and which is totally different from California. And so you take those ideas and you kind of create a standard, and so the EFC makes certain assumptions. One, a modest allowance for standard of living, and I believe what they do with that is they try to take the average standard of living across the country. That post-secondary education is among the family's first discretionary expenses. I know that's preposterous now, but that's the assumption that it's making. If we probably would redo EFC assumptions today, a family's first discretionary expenses would probably be Wi-Fi in your cell phone. Another assumption would be living allowances. So you have 12 months for the family, the parents' portion of the EFC calculation, which we'll get into, and only 3 months of the student, and that's because the other 9 months of the student, they should be enrolled at your institution, and you're considering their cost and your cost of attendance already. And so it's not going to be included in the allowances of the EFC because that will be double counting, if you understand that. Okay, the following factors will determine which formula is used. Dependency statuses, so you have EFC calculations for dependent students, independent students with spouses and no dependents, independent students with spouses. With dependents. And then the eligibility for the simplified needs test or auto zero EFC, and then we'll get into the requirements for that coming up later. And then the number of dependents that you have. So there are 6 different formulas used to calculate an EFC. So we had about 4 different versions of this chart trying to make it simple. And I hope we succeeded with that one. So the 6 different EFC formulas are, you have formula A, B, and C, which is actually 3 different formulas. But then the 3 different formulas have different versions depending on whether you are a regular FAFSA filer, which means you fill out the entire FAFSA, whether you have a simplified needs test, which means there are certain questions, skip logic in the FAFSA that you'll skip over, and whether you're auto zero eligible, which again, will skip over certain questions of the FAFSA. So 3 formulas, 3 different versions of each formulas. Okay. So the simplified needs test generally aligns with skip logic on the FAFSA, like I was just saying, on the web. To qualify for the simplified needs test, a dependent student, anyone in the parent's household should be eligible for federal means tested benefits. We have specific means tested benefits listed on the FAFSA. We often get comments during the FAFSA comment period that we should include more federal means tested benefits, but as you can imagine, there are thousands of different versions of federal means tested benefits. And so we always explore which ones to add. Depending on the consistency of it being used and its relationship between people that go to college and apply for our aid and people that have those benefits. And so I believe we added Medicaid about 2 or 3 years ago. Whether the parent is a dislocated worker or whether the parents filed or were eligible to file a 1040A or 1040EZ, or filed a 1040 but were not required to do so, but did so to get the education credit, or did so because they went to Jackson Hewitt and Jackson Hewitt used a 1040 for everybody. We all know that. Or were not required to file any income tax return at all. So again, we're exploring how the elimination of the 1040A, 1040EZ affects the simplified needs test and the auto zero EFC. But like I said before, we're hoping to maintain the spirit of the simplified needs test and auto zero and maintain eligibility for it with consideration with the elimination of those forms. Also, to qualify for the simplified needs test, if the tax filer parent's adjusted gross income is $49,999 or less. The other way we're often said it is less than $50,000. Or if the non-tax filer parent's income is $49,999 or less. Okay. To qualify for a needs test for independent student is basically the same. It's just for the student and it's not for consideration of a parent or parent's household, and that's important to account because a student who is applying for the FAFSA on the web may have the option to complete parent information even though they don't need to. So even if they do and the parent qualifies for simplified needs test, is still going by the student's information. For 2018-2019, auto zero is the same requirements as simplified needs test, except the income threshold is less than $25,000, which would be $24,999. And for independent students, those without dependents other than a spouse cannot receive an automatic zero EFC. Did you want to? You can use that. You can use that.
Well, yeah, and I can't see people when I do that, but it'll be like the voice of God or something.
No. You can grab the mic and hit a freestyle. Go ahead.
Should it come out of there? Okay.
There you go. Yeah.
So the thing I was going to add is, do you all understand what some of the congressional intent was with auto zero and simple needs test? I mean, they wanted to have a simplified FAFSA experience for some filers, but not all filers. And, you know, with simple needs test, or auto zero rather, the idea is that if the family's income is below this income threshold, and I think it's $26,000, isn't it, Kira, going forward? Not for 1920, I think it went up.
Yeah,
to 26,000, but for 18, 19, 25,000. The notion is that if you have that low of an income and you didn't get to that low of an income through some of the tax deductions that are available to corporations and other kinds of more complex conditions, if you have a genuinely low income, chances are you probably haven't had an opportunity to accumulate much, if any, assets, right? Unless you just became really poor really suddenly, which can happen. But chances are avoiding the asset questions doesn't really cost the federal government anything, because if you're that low income, you probably didn't amass much for assets at all. And so that's kind of the spirit of the simple needs test and the Auto Zero, is to simplify the FAFSA experience, especially for applicants where the data showed that assets really weren't in play.
So if you ever look at an ISAR, you'll see a primary and a secondary EFC. So does everyone know what an ISAR is, what an ISAR is? Okay. Yes? No?
Well,
Okay,
we
thank
pronounce
you.
it differently in the Midwest, but
Oh, what is it? Rhubarb?
I call it an ISER, but I don't know. See?
Oh, really?
Am I right? See?
So it's ISAR, ISER. Wait, are there any others?
You're my
what do you have?
peeps right here.
ISAR and ISER.
ISER. It's ISER.
Or it's ISAR. ISAR? ISAR? Okay, that's not important at all. You guys, come on, stay on track.
Thank you. All
Okay.
of you who sided with me, you can stop up later. I have money for you.
Right. Primary EFC is used for all federal student aid. So that's the main EFC on the ISAR, that comes up in the right corner. The secondary EFC is generally used for non-federal aid awarding, and some states require asset information for state aid, even if it's eligible for the simplified needs test. And that usually shows up as a secondary EFC. And so on the slide there, we list the states that actually, even if you qualify for the simplified needs test, it's still going to ask you all of the information on the FAFSA because they want to use the secondary EFC for their own purposes. If the simplified needs test is met, but the long form data has been completed, then the secondary EFC is calculated using formulas 1, 2, or 3, and that's also A, B, and C. Signature rejects, if the record only has signature rejects, only the primary EFC is calculated and placed in the signature reject EFC field on the ISER. I'm so self-conscious now. The school cannot pay on this record, but when the signature reject is resolved, the secondary EFC will be calculated. So if the record qualifies for Auto Zero EFC, the primary EFC is set to 0, and if the long data form is present, no EFC, secondary EFC is calculated. So it's only calculated for regular EFC, simplified needs test, but not Auto Zero. There are 11 alternative EFCs that are calculated for programs shorter than the 9-month period, and that's also on the ISER.
That's going to mess you up the rest
For
of the
the
week.
rest of my
Yeah,
life.
I know. I feel responsible somehow.
Baby boomers, always. Okay. Each formula uses FAFSA data such as adjusted gross income, household size, and number in college to calculate the EFC. And annually, per the Higher Education Act, information is updated in the tables that we have, both in the EFC formula guide that we publish on IFAP, Information for Financial Aid Professionals. And so we update the income protection allowance, adjusted net worth of businesses or farms, education savings, and asset protection allowances, assessment schedules and rates, and Social Security tax tables. And we'll get into, when we go step by step of an EFC formula, of what all of those tables are used for. And then we'll touch a little bit on the dynamic about how some of these tables and these allowances and Social Security tax table depends on states and ages and things of that sort. So this is where we're going to go through the step-by-step of an EFC formula. We're going to let Craig take the lead on it, and I'll jump in every once in a while and pretend like I know some math. So like my son's math teacher, if you find that we make a mistake and you catch us on it, you get extra credit on your final grade. I'm not too sure what your final grade would get you at the end. I probably should have brought some Dum Dum lollipops or something to award everyone. And so we'll go through it, and then as we go through it, if you find that you have a question about a step, if you can write it down and hold it at the end, and we'll bounce back and forth to any of the screenshots that you have questions about for both our visual and audio learners, so that you're looking at it while we're trying to go through and further explain everything. Okay?
By the way, one of the reasons I think, how many of you have ever, this is such a nerdy question, but I'm going to ask it anyway. How many of you have ever actually done a hand calculation? Oh, you are so my people. Yeah, I love that. So why know this stuff, right? We've all got computers. We calculate this for you. You've got systems that calculate it, make you hit a button, right? I think one of the reasons that it's important to understand how the expected family contribution is derived is because you have professional judgment authority. We don't give you guidance. We're prohibited specifically from giving you guidance about how to use that authority. But one of the things that I did was knowing the components of the formula. You can't change the EFC. You don't have that authority, but you can change the components that result in an EFC. And depending on the circumstances that the student presents in their special circumstance, you can go in and make adjustments based on your professional judgment authority to derive a different EFC when you think the circumstances warrant that. So we're going to go through, how do I do this? I haven't.
Hit down.
Down, yeah, there we go.
Good job.
So income, so that we're going through the dependent student formula. And so the first step is determining the parent's income. And so you can see there that we collect the parent's adjusted gross income, and then we also collect the mother-father's income earned from work, and that's in box 2. And then the parent's taxable income, and we use the AGI from box 1 if they're a tax filer, or we use the sum of box 2 if they're a non-tax filer. You see that? But we collect both items, and because we do use that later in the calculation. And then we look at untaxed income, and you'll recognize the FAFSA elements there, 94A through 94I. Those are the additional untaxed income and benefits that families report. So now we've got a total taxed and untaxed income in line 5, from which we then subtract some of the income adjustments, and those are also reported on the FAFSA in those line items for 17-18 FAFSA anyway, the 93A through 93F, to then finally arrive at a total income for the parent. Then here are some other allowances. So remember, this isn't like, remember the old joke about the really, really simple tax form that said, how much did you make last year? And then the second question is send it in, right? That's not like that. But so there are, in addition to putting your son or daughter through college, families still have to live. And so we have to acknowledge that there's offsets to income that are unavoidable. And so these allowances against parents' income is those things that Congress had agreed would be unavoidable offsets to income that need to be taken into consideration before we can figure out what's left. And then from among what's left, how much is reasonable to be expected could be applied towards meeting college cost. So you see here, U.S. tax paid is one, a state and other tax allowance, and you're familiar with the state and local tax allowance table. It's the reason we ask for the parent's state of legal residence on the FAFSA so that we can place that student family in the appropriate tax state, because there's quite a bit of variance among states in state and local taxes. So this is at least an acknowledgement that state taxes are not evenly assessed across the country. Then we look at parent 1 and parent 2 to determine the Social Security tax allowance, and we use that income earned from work on the previous screen to calculate the amount of Social Security withholding that would have been taken out of each parent's income, up to whatever and I forget, maybe not sure what the maximum is, but it's not too much above 1914. I can't remember now what it is. But so we acknowledge that there's Social Security tax withholding that comes out of people's pay. So now we have the income protection allowance, which is based on table A3, which is in the, excuse me, in the hand calcul EFC guide. And that income protection allowance, Kira mentioned it earlier, is an acknowledgement of the living expenses for the family members who are not going to college and living expenses for the child or children who are going to college but only for 3 months, right? So where's the college students' other living expenses? You know this. Right, it's in your cost of attendance. So if we offset the income for the full 12-month living expense for the college student, and then you're giving, that would lower the EFC, right? And then you're applying that to the cost of attendance where you've included cost of living for the student for 9 months. They'd be kind of double dipping, right? You get it? So that's something to remember when families, in fact, I used to remind people of that. How many of you have had families, when they become aware of their expected family contribution, want to come in and debate with you that it's overstated, too high? Nobody's ever had that happen, right? Every day. One of the things I used to remind them, families, it sometimes helped, was to remind them that the living expenses for the son or daughter is not in this income offset, and that would suggest that the EFC is slightly higher because we are expecting parents to continue to help support their son or daughter even while they're in college and to help meet the expenses, the living expenses that are now in your cost of attendance. And then the employment expense allowance, which is a very interesting throwback. You know, there was a time in this country when it was somewhat rare that both parents worked outside the home. I know it's, in today's context, that's hard to believe, but I've been around long enough to remember when working, mostly mothers, but working mothers outside the home was rather an oddity, a rarity, if you will. And this was an acknowledgement of that if both parents worked outside the home, there are some additional expenses that go along with that. You've got additional commuting costs, you've got childcare costs, you've got a business, you know, maybe a uniform or business attire that you have to acquire. So there are some, just an acknowledgement, there are some additional expenses that comes from having both parents work outside the home, or if it's a single parent family, that parent working outside the home. So anyway, all of those allowances that you see on the screen then are summed up to be as an offset to income. So now we're at the available income step. So we take that adjusted gross income from the first worksheet, we subtract the total allowances, and here is a number called available income. This is of that whole $41,215, the only portion of that income that we're going to even consider, that's even going to go on playing the game, if you will, is $2,618. All the rest of it.
Can I stop you there?
Yep.
And go to the previous slide? So I want you to notice where he is now. We're about to go into asset information. If you go to the EFC formula guide, once you get to the bottom of these allowances, because the next section is asset information, it's going to tell you that you can stop there if the student is eligible for the auto zero EFC, if you see the note there, because we don't even want the asset information. So you would actually stop here in the hand calculation. Right. But we're going to keep going forward as a full EFC calculation for the purposes of this example. And
by the way, I'll just mention the data shows, even for the people that fill out the complete FAFSA, assets just rarely make much of an impact on the total bottom line of federal Pell Grant expenditures and expected family contribution. It's just really not usually a factor. It makes sense. The people who need help the most paying for college are probably people that are least likely to have been able to amass much in the way of assets. Okay, so here we go. So now we're asking for things like cash savings and checking, net worth, which is the value of an investment less it's any liability against that investment. Same with business or farm. Remember, if it's not a small business and not a family farm, and you know the definitions of those. And then, so then we have adjusted net worth of those things, and we sum all that up to come up with a net worth, in this case, $12,000. Then we have an offset to those assets, the first of which is education savings and asset protection allowance. Some of you may, I know we got inquiries from people asking about, that table changed pretty dramatically for, I'm losing track of years, 18, 19, I think, dropped some. And so I wanted to explain a little bit what I learned when I was a puppy as to the purpose of the Education and Asset Protection Allowance. There is a pretty complex set of estimates and calculations that go into that particular, in the Asset Protection Allowance. And the story, the way it is told, is that the government does a calculation of a couple of things. We estimate what do we think Social Security payout for a retiree and their spouse will be when each individual reaches the age of 65. We also are constantly calculating what's the average life expectancy for American men and women. Did you know we do that? The federal government, not the Department of Education, but people are calculating the average life expectancy, and that calculation changes continuously. I'm happy to say it's going up. It's more important to me than some of you. And we're also estimating inflation. Every year, we keep a constant tab on projecting what inflation is running. The reason for that is this. We recognize there's a recognition that there will be some kind of a gap between what Social Security payout is expected to be when you reach age 65 and what we calculate will be necessary to maintain a reasonable standard of living. There's a gap. The Asset Protection Allowance is designed to protect a certain amount of savings, the amount of which would be enough to buy an annuity that would generate a monthly revenue stream to you, a monthly income to you, sufficient to fill that gap. Does that make sense? So that Asset Protection Allowance is an acknowledgement that there's a legitimate reason for you to save, to have a little bit of money put aside. So why does the Educational Asset Protection Allowance fluctuate? The reasons are twofold. One, this year, Social Security recognized a fairly significant, I think 2% increase in Social Security payouts. So the Social Security payments went up. And the administration's calculation estimate of inflation was down. In other words, the gap between what Social Security will be paying when you're 65 and what we estimate will be a reasonable standard of living at age 65, that gap has narrowed this for now, right? Now that can change. But for this year, the Asset Protection Allowance came down fairly dramatically compared to the year before, and that's the reason why. Some people were alarmed because of the change, because 3 or 4 years ago, you may remember, the Asset Protection Allowance, actually we published it and it was wrong and it had an error in it. And I was a brand new employee. I'd only been there 30 days, and the first thing I was given was to try to figure out why and how and what was right and stuff. So I cut my teeth on this Asset Protection Allowance when I was brand new to the department. Anyway, probably more than you wanted to know about that table. So, and then discretionary net worth is the amount, if any, if you had savings, if you had assets greater than the Education Savings and Asset Protection Allowance, then you've got more assets than you need for filling this gap that I've been talking about. In this case, you can see that is not the case. This family has not managed to save even as much as they will need for filling the gap. And so there is a negative discretionary net worth, which we treat as zero. Had there been a positive value, if let's say the net worth was $20,000 instead of $12,000, and there would have been a $3,500 discretionary net worth to the positive, then the formula expects 12%. Only 12% of that excess asset would be available to add to income to calculate the EFC. So here we bring it all together. So we have available income. We had no contribution from assets. So we have an adjusted available income figure. And even then, remember, if you've kept track in your head kind of how we got here, we have adjusted gross income. We take away all the income offsets. Now we look at assets. There's nothing from assets. And we come down to an adjusted available income, $2618. And even then, we don't expect every dollar of even that to be available for college education. We put it through this adjusted available income formula that's, again, in the workbook, and we come up with a parent's contribution from adjusted available income of only $576, or about 25 cents on the dollar, roughly. And then the most dramatic effect on expected family contribution, as you all know, is to divide that number, because that's the amount that the parents can pay for children in college, and it has to be divided by the number of children who will be in college at the same time. In this case, there was only one, so the $576 just carries down. But if there were two in college, we would divide that $576 AAI in half, which is why family size number in college, when you're doing verification, is such a critical verification item, isn't it? You hope you get the same answer again as what they gave you when they filled out the FAFSA, but we recognize that things change. So the dependent students calculation is really similar, but quite a bit simpler. Again, we do the same thing with income earned from work and the taxable income. We have untaxed income and benefits, et cetera. We go all the way through. I'm not going to bore you with all the detail there. You've seen it. There's the same state and local tax allowance, Social Security allowance, and an income protection allowance. And so one of the things I think that's interesting to note here, that income protection allowance of $65.70. How many of you get questions from people, is it going to hurt my son or daughter to save his babysitting money or his lawn mowing money, right? I see some heads. One of the things I used to say is no. I mean, not the first $6,570, and that usually most young people, their incomes fall well below that threshold. So the first $6,570 doesn't have an impact on this at all, right? As far as income, we'll talk about assets in a minute. So here's the total allowances. We go over here to the contribution. The total income is far less than the total allowances. So there's no student contribution from income at all. In this case, the student made $2,100 in the base year. There's no expected contribution from the income at all, because it was well below that income protection allowance of $65.70. Then we asked the student about savings, and I can remember when the assets of a student was treated far more critically than it is today. That's even softened. But the cash, this student had $1,000 that he or she saved, and no other investments or net worths, and that we expect 20 cents on the dollar is contributed available, which makes sense, doesn't it? If it, in a traditional 4-year or 4.5, 5-year education, the student wouldn't even be expected to pay all of their savings towards their college education. It's going to go down 20% a year, and then based on what they save. So again, you can see the effects. I think knowing this formula helped me explain to families who have it in their minds, I think sometimes, that this is more critical than they understand. And so if you understand the formula and how it's derived and some of the logic behind it, I think it always made my job easier to try to explain to families what we're trying to do. So the bottom line is, when you see this on the right-hand side, the expected family contribution, so we have a parent's EFC, the parent's contribution of $576, student contribution of $0, student's contribution from assets $200. We add it all up, and here's one of the most fascinating things to me. We add it all up, and what do? Drop the dollar sign. Do you see that? Isn't that interesting? Nope, it's not. They're not dollars anymore. They go through this magic box, and it comes out the other side as an expected family contribution, which is, that kind of harkens back to when it was a student aid index number, an index number, not dollars. Now, the more ironic thing is, what do you do with the EFC? You subtract it from your cost of attendance, which is in dollars, and lists need in dollars, but the EFC is not dollars. It's an index, so whatever. But it's one of the mysteries of life. This is just to show you that on FAA Access and on the ISER record that you get, ISER record, that all of the interim calculations that we've discussed here today are there for you. You can see them. So one of the I mean, you're going to laugh at me, but fun things you can do would be, for those of you who haven't done a hand calculation, would be to take the EFC guide, take an ICER record, don't look at this part, and do a hand calculation, see what answers you get, and then go back and check your math to this detail to see where you missed. My first job many years ago, we did all hand calcs, you know, I'm old, and we didn't have computers, and so we did hand calculations, and they would sample 10 of the thousands of cases that I would do over the course of the year. It was a big school, and they would double check. They'd give them to somebody else to double check the hand calculations on those 10. And my performance evaluation was based on how good a job I did. I remember I was scarred. I got one wrong. I was 9 out of 10, and I thought that was really bad. And you know, I probably missed it. I was probably off $3, but not dollars, 3 something. 3 EFC
3
points.
indexes?
3 index points, yeah, whatever. But I remember very distinctly, I only got 9 out of 10. I was just horrified that I'd made a mistake. So anyway, so you can do that, and we give you the information. Are you going to talk about formulas?
No, you keep going.
Oh, I'd rather you do.
Okay. Some EFC factors vary among the independent formulas. So he already went through that the tables will adjust depending on states, the person, whether it's the parent, the student, age, household size. I believe those are ones. So you have income protection allowances adjust, employment expense allowances adjust, student contribution from income adjusts, and student contribution from assets adjusted. So these are the references that we've mentioned verbally, so you know where to find them on IFAP. You have the 1819 EFC formula guide. That also has the worksheets in it for all the different formulas if you have absolutely nothing to do this upcoming Christmas holiday. You could sit around and did it. My career in financial aid, the computer always did it. I still actually went to do a hand calculation. The first time I tried, about an hour and 20 minutes in, I threw it against the wall and said, forget it. But go back and keep trying, and eventually you'll get there. If you really want to have some fun with it, give it to your kids and let them try. You have the 1819 Federal Student Aid Handbook. The application and verification guide also gets into the EFC formula. And we have some more information there in Chapter 3. And then the 1819 EFC formula tables are published in the Federal Register notice each year because, as we hinted towards, the tables do adjust every year. So this is the contact information. Please do not call or email me asking me to help you hand calculate at EFC. Please leave that to Craig. He has absolutely nothing to do all day long, and we'll be waiting for your call.
So let me conclude too with this. I mean, there was a time when this methodology, I mean, I can't remember all the reiterations and what it was called, but I remember once it used to be called uniform methodology, and the formula was not in the statute. You know, it hasn't been in the statute since 1965. It's only been in there recently. I forget when. But it used to be college aid administrators, just like yourselves, that would meet annually and have a conversation and discussion of what's the uniform and agreed to method that you all, were going to agree to use to determine a family's ability to pay for college. And that has been all over the map. I was telling Kira the other night when we were just talking through our session, I remember there was a guy from North Carolina that I had, when I worked at Illinois, I had him come up and speak to our state association. They had been dabbling with some other ways, other than base year income, ways of assessing a family's ability to pay. And this was the one that I remember. There was a name for it that I've since forgot, but they were going to collect like 20 years worth of family income data. I know, don't go there, I know. But for the purpose of assessing what was that family's propensity to have saved? How well could they have planned for their child and then to go to college, and then assess the grant to loan ratio would be dependent on whether that family could have saved and didn't versus never had the opportunity to save. So if you'd had a pretty nice income for 15 or 20 years and just didn't set any of it aside for your child, it's like your child was born 18, then you'd probably have a bigger loan to grant ratio, right? But if you were like the simple needs test or auto zero families that we were talking about, and you'd always been pretty modest income, low income all your life, you obviously didn't invest in a 529 plan. You couldn't. You're just trying to make ends meet year after year. Then that family would be eligible for a heavier grant to loan ratio because they really didn't have the opportunity to have saved. So kind of interesting. So Congress, though, did express concern that billions, literally billions, of federal dollars were being allocated and awarded to students based on a formula that Congress had no hand in creating, that was coming from the community. And they finally concluded that probably wasn't good business practice, good government, and intervened and put needs analysis in the law. Just an aside, and then we'll quit and open it up to questions. When Jeff Appel, and probably during the open forum later today, talking about Children of Fallen Heroes, that Children of Fallen Heroes Scholarship Act is actually in the needs analysis section of the Higher Education Act. It's just another EFC shall be zero when these conditions are met, not unlike simple needs tests and auto zero. Okay, we told you everything we knew about EFC, and a couple of things I think we made up as we went along, but no, I'm kidding. But now it's up to you. Now it's your turn. Do you have questions for us? And we'll open it up. Just if you would go to the mic, though, to ask if you do have a question. Is it? No.
You go first. Oh.
Now it's on.
Now can you? Okay.
Oh, there it goes. Okay.
All right.
Hi.
My name is Katie Starling from Kansas State University.
Yeah. Oh, my. That's back home.
Yes, I
yeah.
remember
Good
you.
to see you.
Kansas.
Ramaspa.
Another one of the flyover states that Kira has never visited, by the way, but we're going to shame her into coming back to the Midwest one of these days.
Does the Wizard of Oz count?
Go ahead. Go.
So I have a question, and I know this is very down into the details. One of the additional financial information, the subtractions from total income, is the education credit. And it was explained to me that the reason we subtract that in the same way that we would subtract federal taxes paid is because if they hadn't gotten the education credit, their taxes paid would be higher, right? So it kind of accounts for that, right?
Right.
So I've got a redacted transcript. One of the things when we do verification and we verify taxes paid is to subtract out any excess advance premium tax credit.
Okay. I'm still with you, I think.
Okay, so that doesn't count as federal taxes paid. That's just something, okay. But if they have excess advance premium tax credit, it increases their education credit, and it's not subtracted out of that. Does that make sense?
Did you track on that? We might have to have you, we're going to need visuals, I think.
I brought them.
Come up afterwards, let's look at it.
Absolutely.
I don't know. Off the top of my head, I'd have to look at it a little careful.
Well, I'm
Yeah.
gonna
But it's a
sit down and
really
watch
good
it.
question, and I knew that somehow this session would turn out to be about verification.
Oh,
I
I
just knew it.
saved all these questions.
In our defense, the reason we have to look at it is because we are literally working with like 3 different years of tax forms. We have 16 we're looking at, 17 we're looking at, and the entire
And 18.
annihilation of all the IRS tax forms now. So when you say I'm looking at a redacted transcripts, our
That's-
mindset,
Yeah, thank you.
No, I
Which one?
apologize. I redacted it. I cut all the
Oh,
stuff out.
okay.
okay, now I'm back. I thought
I
you were
brought
talking
it.
about a redacted
No,
tax
no.
transcript, right?
Right.
Okay, I'm
Sorry.
back. Okay, come up afterwards.
I will.
We'll figure it out.
Okay, thanks.
Thanks.
Real quick question, mine I think is going to be very easy, and it is ICER. So thank you for clarifying that.
I know, right?
Our Midwestern.
I am glad, if nothing else, we
Wait
got
a
that
minute.
straightened out. You know, and you thought this
Wait,
session
wait,
may
wait,
not
wait.
be that interesting.
wait, I'm from Baltimore with a D, not a T. And I drink water. Okay.
We have potlucks and make hot dish where I'm from. So, my quick question though is this: can you talk a little bit about enrollment periods and how that plays into EFCs that we use specifically for partial year scenarios and 12-month year scenarios? Does that make sense?
Yeah, I'm afraid it does. I'm not the best person.
No, I can probably touch on a
Why
little
you
bit.
trying?
So that's when you get the difference between the 9-month and the 12-month EFC. Most of the schools default to the 9-month and don't even know that they can use the other EFC when you have a program less or more. So it really depends on the design of your calendar year and your enrollment period. So if your enrollment period is, okay.
Yeah, no, you're doing really good.
Okay, so if you're, like, you can get really complicated with the EFC. So if you have a student who's in their senior year and only have 1 semester left, technically you don't do a 9-month EFC, you would do a 3-month EFC. So when you're looking at your, I mean, did I say 3 months?
Yeah, that was
No,
wrong.
4.5.
Yeah, 4.5 months.
Okay,
Right.
4.5 months.
I'm doing the math in my head while
I
you're
know, but you
talking. I
didn't
had
jump
that.
in.
Okay. No.
You would do the 4.5-month EFC. And so when you look at your enrollment period, you just want to look at your calendar and how long it is.
4.5 months. How are you? Isn't it either 4 or 5?
Yeah, it's either 4 or
Okay.
5. It'd actually be 5. Yeah.
Thank you.
Right.
And then the scenario where, sorry, I don't mean to jump back in here with more questions. I thought it was going to be a very simple answer. A scenario where someone has gone fall, spring, and used up what I would describe as their 9-month EFC, and now they want to go in the summer. My understanding, and is this correct, that they have used up their 9-month EFC, so there really is no EFC assignment for summer enrollment?
No. Remember when we were talking about the standard maintenance allowance for the family, not only including 9-month, only including 3-month living allowance for the student. If the student's in school all 12 months, that's even wrong, right? So the 12-month EFC minus, is it 12-month minus the 9-month? I don't know.
But there's an actual separate worksheet in the EFC formula guides for enrollment periods longer than 9 months.
Longer than 9 months, but it's in part to adjust for that expense allowance error, if you will, because they're assuming that the 9-month calculation assumes that the student is living at home for 3 months. If they're not, then that EFC can't be used.
Okay, thank you.
Yeah.
Hi, thank you. I have a really quick question. So part of the formula, it says if, let's say you have a dependent student parents and the income from work is negative, it's like Schedule C income and it's negative. If you have 2 parents that are working and one parent has wages, let's say $10,000, and the other one has only Schedule C income of negative $3,000, if you put that as 0, then they're not getting that $4,000 expense allowance for 2
They're not
people
getting that
working.
part of it, yeah.
Is that
right.
still accurate? Are we supposed to be putting in that negative 3,000 for that
Yeah,
second
I thought
parent
that
so they
was
get
the
that?
Doesn't Schedule C go in, because the total income is 7, 12, and 18 on the tax form. And
Right.
Schedule C, I
Yeah.
think, is 12.
Right, but if it's a negative, you're supposed to treat it as 0. And I know you're never supposed to subtract it. Like, let's say a parent has some positive wages, you never
Right.
subtract it because then they don't get that Social Security. But if the only income that one of the parents has is negative, then they're not going to get that $4,000.
I'm going to disappear behind the podium a minute to confirm with my colleague. Just hang on, just hang on. Do they get the income expense allowance? 2 parents both work outside the home, one has positive income, one has negative income, they still get the employment expense allowance. We don't treat a negative number as not working outside the home.
No, there's a parent benefit. If you go back to the thing, it's the lesser of the 2 for most parents who work outside the home.
Well, yeah, but in that case, the negative income is the lesser. We're going to look that one up later, too, so we don't know.
Okay.
You guys ask really hard questions. Oh, and then
That was
she's...
my goal was to stump
I know,
you.
you know what? And you're so young, too, and yet I would have taken you for somebody that didn't know what the EFC was. And then Kansas State's back.
Well, she asked one of my
I'm
questions.
just kidding.
Okay, the parents' income earned from work or students, when you multiply it times the Social Security table to
Yes.
protect, okay, why do we use box 1 from the W-2? Why is it box 1? Because 3 and 5 are the lines, you know, for Social Security and Medicare. And
I think it's because, I think I know this one. There is a different income threshold that you continue to pay. You continue to pay Medicare withholding beyond is it 118,000 or I forget, lost track now. You know how you stop paying Social Security once your income exceeds the income threshold, but you
Well-
continue to pay the Medicare contributions beyond
right, but
that.
box 3, so box 1 is federal, box 2 is Social Security, box 1 is federal, box 3 is Social Security, box 5 is Medicare. So why not box 3? You know, when people have tax deferred plans, it comes out of box 1, but box 3, they're still paying Social Security tax on their 401k
Yeah, I
contributions.
don't know the
and-
answer to that either. Gosh,
I
you
actually
guys
know
are-
the answer to that one.
You know what? Next year when the other two sessions, we should make sure that the mics don't come on.
Or Kansas is not allowed in.
Yeah. No, she's really good.
No, the real answer to that question is actually a lot of the guidance that we get when it comes to tax forms, what boxes and what line items to use, we do in collaboration with the IRS. So it's oftentimes when we give that guidance, we may be confused also, we may disagree, but the IRS, we have to give them jurisdiction
I
over
want to
their
look
own
at that. I'm
forms.
curious now myself. It's a good question, I think. And then over here, yeah.
Yeah, so my question has to do with parents' assets. When you get to the discretionary net worth, and then
Yeah.
there's that asset conversion rate of
Yeah.
12%
Yeah.
that's applied against that, I was wondering why 12%, where does that come from? Is that set in the congressional methodology? And am I imagining that it used to be a different percent like years ago?
I do think, the 12% I don't think has. The adjusted available income percentages have changed over time. That I know for sure, but I don't know about the asset protection allowance. And where that came from, I don't know, but I think it goes again into the idea that 100% of your discretionary income is not expected to be available to all go towards the education of your child, that there's an acknowledgement that there are competing priorities for our resources, savings and income.
Okay, thanks.
Yeah.
I remember it being a different percent too.
Do you? Okay,
Yeah.
then it may be. I don't remember, but what did you think it was?
0.04.
Oh. I vaguely, yeah, I'd have to go back and look. I don't remember the history well enough to be able to state that
I just
for
remember
sure.
explaining to students
Yeah.
and parents who were asking ahead of time and talking about planning that your students' assets are going to be assessed at 20%, where parents' assets are, after all the protections, are only assessed at 4%.
Well, and the student, I know that has changed. That used to be 35% for the
Right,
student,
right,
for
yeah.
sure.
I
And
remember it
that's,
coming
and
down.
that's come down. And so, right, which is one of the, this is another side thing, just thought of, the treatment of 529 plans for a dependent student, even if it's in the dependent student's name, the 529 asset is reported as a parent asset, as an acknowledgement that, so it's taxed at that lower rate, the 12% rather than the 20. Over here.
Yeah, it actually comes down to 5.6 usually because of a 40% cap somewhere deep within the methodology, so that might be what most people remember. That's what parents are usually told,
Yeah,
5.6.
right.
Thanks for the 529 segue. Grandparent-owned 529, distribution in sophomore year versus second semester junior year, both income and asset treatment.
Well, first of all, the 529 plan wouldn't be counted as an asset because it's owned by the grandparent. You're talking about the distribution from the 529 plan
Being counted as
as,
income or EFA, depending on how it went.
You want to elaborate? Like say $10,000 comes out from grandma for the student
Right.
to the college, sophomore year. Still have another FAFSA to file to report it.
So is the year mattering because it's going to be what tax year it's falling into?
Well, when you report the next one, then it's income, right?
yeah, if
For
it's
the
income,
student.
it'd be 2 years later. If it's
Right.
EFA, it's now, right? Yeah.
Income
You
to
know,
the student, right? Student income?
You guys came here just to hear me say, I don't know.
I'm sorry.
didn't
I just want to know.
you? I don't know. We'll have to look. I don't know.
Okay.
I know I've not had that particular question. I was just looking at 529 plans from parents. We were looking at that the other day. But I have not looked at how distributions are counted when they're from someone other than the parent. Yeah. Uh-oh.
Right. There you go. That's what I was looking for.
Yeah.
Right.
Right. I'd have to go back and look at it to give a definitive answer, so I'm sorry.
Okay,
But-
and now for something completely different.
Oh,
Let me
good,
pipe on
okay.
for you. Rental property, LLC, mom and dad run everything. Dad does the books, of course, gender specific, and mom does all the construction work. How's that treated?
It's
It's an asset.
an asset, yeah.
At what point is a rental property not an asset? That material participation, IRS?
No, I believe in the FAFSA help text, we say it's a home or, what is a house called?
Domicile?
No,
Residence?
no, residence, no, not.
I just know what we call it in the
Real
Midwest.
estate,
I don't know
real,
what you
I'm
call
gonna
it in
use real
Baltimore.
estate. I'm gonna use the real estate word.
Okay.
It's the only time that we're not looking at it is when it's your primary place of residence.
Otherwise,
Otherwise,
it's an asset.
it's an asset.
Same
don't know
So
about
whether,
the
whether or
material.
not they swabby enough to get it down to zero in their Schedule C or something is a whole different
So
subject.
you're not familiar with material participation, excluding that as being an asset?
Even if you're a duplex and you live downstairs and you rent upstairs, you're supposed to figure out how much of the upstairs part is an asset for the FAFSA.
I'll email you. Thank you.
So tagging off of that then, because we've got people that's their business. Is it the second question of the assets, investments including real estate, or is it the third part where it's your business or farm and both mom and dad are working it, so there's only 2 employees and they're doing it all themselves, and then is it the net worth of business, which is
Right.
protected drastically
Right.
versus net worth of investments?
The small business is excluded if it's under 150 employees, and I thought that's where he was going to.
Oh, is that where he
And
was
that is where
going?
you were going. Yeah, right. I think technically that's right. That
So
it's
they would have to have an LLC and run it,
Right.
okay.
As long, it has to be a business, it has to qualify as a small business to be excluded.
Okay, so then I had one other. An HSA, a health savings account, okay? So contributions into a health savings account on your W-2, like it's usually in box 14, so
Yep.
it doesn't go on the FAFSA. Okay,
Right.
Right.
It reduces taxable income?
it does,
Yep.
yeah. So it doesn't go on the FAFSA, but if it's on line 25 of your 1040, if you don't have it taken out of your W-2, but you make a contribution to your HSA, that's allowable, within the IRS
Yeah.
limits. If it goes on line 25, it's countable as other untaxed income.
Because it doesn't reduce your taxable, right?
Well, it's
That's-
reducing your AGI.
Okay,
It's an
ask your
above-the-line deduction.
You're gonna have to bring a W-2 up here for me to look at
Oh,
that.
I didn't bring a W-2. I'll find one.
No, but I'm following
you
you because,
following
because I'm unclear with the issue because
Well, okay.
if it's on the W-2 and it's being, reducing the income on the W-2 or reducing the income in the AGI, it's still the same.
Yeah,
reduction,
but it's
it
not being
sounds like.
treated the same. So I contribute to an HSA, let's say, all right?
Okay.
And I tell my employer, I'm going to do $5,000. That's below the limit. And I change my mind later, and I don't file it through my employer, but I go ahead and deposit the other $1,500 or whatever it is that brings me up to the IRS limit for the year, right?
Yes.
That goes on line 25 of my tax return. It reduces my AGI. I don't count the part that's on my W-2 in box 14, the part that my employer took out, but I do have to report the $1,500 that I put on line 25. It's the same money going into
Yeah,
the same HSA.
money. I see your point. It's just treated differently because how it was contributed. Yeah, I don't know that, I don't have an explanation for why, but you're right.
So is that does that have to go to Congress, or is that part of the, where do these things get decided?
Yeah,
That
that's a
would be,
good,
that would be congressional. That's the needs analysis formula.
probably. It's spelled out in I can show you in the law where it's
Yeah.
specified, and I honestly haven't committed to memory all
Yeah.
the different.
We don't have the
pieces.
authority to sway from the needs analysis formula, so.
Well, I hope you got something out of this. Oh, there's one more. Yeah, go ahead.
I want to go back to the LLC rental property piece because
Okay.
I specifically asked the department this question this past year.
Okay.
And I was specifically told rental properties are treated differently, whether they're an LLC, S Corp, whatever.
Okay,
And even if you look in the Federal Student Aid Handbook, it specifically talks about rental properties being different. Only can be counted as a business if you're providing regular kind of cleaning, maid service, and that sort of thing for the properties. I was told specifically by the department, those are still counted as assets even if they're in an LLC.
I agree with that.
okay. Does it matter? If they're treated as a personal asset or business asset?
You mean on taxes?
No, on the needs analysis.
It's treated differently on the needs analysis. The business asset is protected, where if it's reported as investments including cash savings, checking, real estate,
Right,
it's not got that 40% reduction.
okay. You've asked some good questions. We'll take those back, and maybe we'll have an answer by the open forum, either this afternoon or tomorrow. Hey, thanks for coming. We overstayed our welcome here, so thanks.